Thank you so much for joining us. Our first story is really representing a sea change, I believe, in reverse mortgage lending when it comes to innovation of loan products. Just last week, Longbridge Financial announced the launch of their HELOC for seniors. We're going to get into all the details, but it's quite an interesting product, and I think it really does address a need that has been in place in the market for many years, if not a decade or longer. So, are you fixed on a budget? HELOC for seniors can help you fix that. Now, let me just say a few things about home equity lines of credit. For the right person, they could be a great fit. However, when it comes to older homeowners on a fixed income, it can be a real rat's nest of problems. For example, after the draw period, their loan is going to amortize, and that's going to create payment shock. And for someone on a fixed income, that's a big challenge. Approval in as few as 5 minutes. Can you imagine that? Here we are in the age of technology, and funding as quickly as 5 days. I did speak with some of the management at Longbridge Financial and confirmed that has in fact been the case with these HELOC for seniors that they've already completed. And interest-only payments are nothing new to home equity lines of credit. In fact, they're required on a traditional HELOC. What's unique about this product, though, is that the interest-only payments, that's all that's required for the life of the loan. This loan, unlike a standard HELOC, doesn't recast into a fully amortized loan, because we know with a traditional HELOC that creates payment shock, right? That payment can go from interest only up to fully amortized by 40 to 60%. So that is one thing that I find very interesting about that. And also, unlike a reverse mortgage where no payments are required, it allows them to keep that loan balance from really growing over time because you're paying off that interest as you go. Depending on the value of your home, you can get up to $400,000 in your HELOC for seniors, and that is a nice sizable chunk of change. Fast online approval, as I said, you could be approved as fast as 5 minutes, and your cash could be in your account as quickly as 5 days, and flexible qualification process. So it helps solve a number of issues that retirees find themselves facing, and that is cash flow issues, unconsolidated debt, variable interest rate spikes or payment shocks, and home repairs. So next, let's go to the small print, which I've made not so small thanks to a little bit of zooming. So it talks about Longbridge being a licensed mortgage banker in the state of New York. It talks about approval. Approval may be granted within 10 minutes, but is ultimately subject to verification of income, employment, property value. Now, the loan amount that one may qualify for on this HELOC for seniors can range anywhere from $50,000, which is the minimum amount that you must qualify for this particular HELOC, up to $400,000. Another very interesting point about the HELOC for seniors is Longbridge's structure has them taking a minimum of an 80% lump sum withdrawal at closing or up to 100%. And the first withdrawal that the homeowner takes will be at a given fixed rate, which will be for the life of the loan, obviously. Now, if they come back later to get, let's say, the other 20% that's available to them, it would be at the prevailing fixed rate established by Longbridge at that time. Digging a little further, I found out there is a minimum FICO score of 660 or higher, and also a combined loan-to-value ratio that can be no higher than 75%, and a DTI, or debt-to-income ratio, that's less than 50%. In speaking with a member of Longbridge Financial's management, a really good point was made, and that is the sales cycle of this particular unique loan. It's extremely short, unlike a conventional home equity conversion mortgage or even a proprietary reverse mortgage, where that sales cycle can take several months, 6 months or even longer, as you're working the homeowner through the process. Not because of underwriting or processing, because it's a longer decision cycle. But with this HELOC for seniors, it's more of, yes, I know I need equity. I'm going to go ahead and get it now, and I'm going to find out if I'm approved. So it really moves that process along much more quickly, and I think that's very attractive for the home owner and also for the originator. Lastly, I should let you know which states this product is available in. It's available in Arizona, California, Colorado, Florida, Georgia, Idaho, Massachusetts, New Jersey, North Carolina, Oregon, Pennsylvania, Utah, and the state of Washington. And there'll be more states to follow. We'll keep you up to date as this particular product evolves. Next, we have a recently recorded interview that we did with Jesse Allen. He is the president of retail reverse mortgage lending for Rate, formerly Guaranteed Rate. And I've noticed they've had some steady growth in recent months, and I've been in communication with Jesse. So here is the full interview with Jesse Q. Allen from Rate. Jesse, thank you so much for joining us here on HECMWorld Weekly Podcast.
Shannon, it's great to be here. It's always nice to speak with you.
Last several months, I noticed that the number of loans that Rate is doing, endorsements, has been increasing. And so I reached out to you a couple days ago and we chatted about that. But if you could share with our audience, number one, what's driving that growth? And secondly, what kind of changes are you seeing in our marketplace?
Yeah, thank you. I appreciate it. I tip my hat to the team. We've had some good growth. We've done some social posting on this, and we're up about 60% year over year in the number of clients we've served, and our volume's more than double. And that's really, I'd say, boils down to three things. We've transformed the capabilities here at Rate that we have to serve more clients. We are quickly onboarding more product specialists into the ecosystem. And then the third is just harnessing the power within the Rate platform. That's the people, the technology, and I think the winning culture has been what's driving that success. And a lot of that, I also think, is an easy gateway into how do we, we're serving more clients. 40% of the clients that we've served year to date were proprietary through the private label proprietary products. So we're beginning early stage to begin to broaden, I think, the nature of the buyer that we're serving. And again, I stress early stage.
Can you give us an example of how your culture helps drive that mindset of looking for these opportunities, maybe that haven't been the traditional market?
Yeah, I think, and when I think about what's driving growth, we know the demographic trends are out there. We know that this active adult population is growing at 10 times the rate of the non-senior population. And we know that people are sitting on trillions, 14 trillion last count of housing wealth. And we've seen industry modernization. So I talked about proprietary products. So we're seeing product innovation more so than we've probably seen in recent years in the industry. Awareness is in a new place. And so what we've tried to focus in on, and I think this is the gateway to serving more clients who don't wake up and go, oh, I need a reverse mortgage. The industry does a good job traditionally of serving those, what we would call the more needs-based client. But I think as you start, what we've done is focused a lot in on building awareness of not all reverse mortgage products are the same. So really focused in on people over product and really diving in relentlessly on client scenarios. When you have a client situation, a family situation that looks like X, modifying the home, taking care of mom and dad or aging parents or grandparents states away, paying for in-home care, wanting to buy a new home, but not wanting to use all of their cash to do that or not qualifying for DTI. So we have been relentless at educating around the client scenarios more so than product, and then trying to match those scenarios with, hey, here's how we've solved that problem for a client. And that has really begun to broaden awareness, and really has begun to we've begun to get people to think about client people over product, and some of that success that we're beginning to see is rooted in that.
So that what you just described is problem solving over product placement, and I think that's so important. And so your sales team has to be very skilled at kind of navigating that conversation, right? Fact finding, that sort of thing.
Um, Listen, every sales force is a distribution curve. I love our sales force. We have quickly added specialists, as I mentioned, and we have the beginnings of a nice melting pot of talent joining Rate from other platforms, and I'm very proud of that, and I'm very grateful for the sales force we have. And again, it's just sweat equity. We're constantly rolling up our sleeves and reminding our own sales force and building in their skills around the product, product knowledge, guideline nuances. As we're educating internal and external referral partners, on the client use cases, we're also educating our own sales team. So yes, we put a premium on, yes, I'd like to think we're hiring a really talented group of folks. And then once we do that melting pot idea, now we're continuing to invest. The real work starts when they get here, and we're going to continue to invest in the tools and the technology and the product knowledge to help them do a better job serving their clients and their referral partners.
No, I think that's it's imperative, I think, for our industry to grow, to have that ability to solve problems. But to do that, you first have to be able to have that conversation to uncover them. It sounds like you're kind of training around a narrative so people can, the switch goes on. They go, oh, yeah, that's how this could work.
Yeah, it's that the narrative. It's around the why. So if I were 2 points, it's like, hey, we're focusing on no product in financial services that I've seen has the emotional and financial lifetime value that reverse mortgages can have. Okay, it has a huge impact. And so how do you harness that and make it about the client's why? What's that emotional value the client's getting out of this deal? And I think that why is so unique, because then the product pieces start to fall into place, right? Whether it's FHA HECM, or it's one flavor of the proprietary, or it's a traditional mortgage, frankly. So it's around the client's why, and reinforcing the necessity to really zero in on that with our sales force and in our referral partners. And then it's also around just using technology to engage with clients at what I would call the point of thought. And I didn't invent that idea. I'll give Brian View, who's the chief operating officer of a company called FinLocker, who's in the mortgage space. He coined that in one of his podcasts, and it's just so appropriate to our business. I think it's applicable to all of mortgage, but in our business, when clients or families start to feel a pressure point or an opportunity, could be, I want to go buy my dream retirement home, and this is not it where I've raised my family. And they're trying to, they start to have that point of thought around solving a problem or going after an opportunity. How do we teach our folks to focus in on the why, what problem or opportunity folks are going after, but then how do we use technology effectively to insert ourselves into that discussion at the point of thought, not when the client's already ready to make a buying decision. And I think with reverse, such a niche industry, injecting ourselves or showing up as people are beginning to think through these problems and opportunities, and using technology to do that is super important. So again, we're very early stage on all of this, but it is about the client why. It is about using technology in new innovative ways to make sure we're present in a relevant way, in a competent way, when it matters most to that client, and then trying to nurture that relationship over time.
Well, it's that client's why that gets us out of bed in the morning, right?
That is it. Absolutely.
Any last words you want to share with us before we let you go, Jesse?
No, I appreciate the time as always. It's been great. I think there's never been a more exciting time to be in our business for numerous reasons. I think we've hit on some of them, and I look forward to seeing you again here soon.
Thank you, Jesse. We'll see you at National, and hopefully many of those watching and listening will do the same. Thanks again.
Thank you. Bye.
As we've covered here on HECMWorld.com, in recent years there has been an expansion of a unique yet growing segment of the home equity marketplace. I am talking about home equity investments, or home appreciation agreements, and they have been facing quite a few legal woes in recent years. In fact, just in August, the Ninth Circuit Court of Appeals in Olson v. Unison, the court ruled that the home equity investment are actually subject to mortgage laws, not just being seen as an option agreement. And then back in February, the Massachusetts Attorney General filed a suit against the home equity agreement company HomeTap and accused them of predatory lending practices by marketing the agreements being disguised as investments, but they actually claim, at least the state of Massachusetts, that they are illegal reverse mortgages. Then on August 15th, the Illinois Department of Financial and Professional Regulation, they rolled out proposed rules under the Residential Mortgage License Act, and these are really the state's first attempt to regulate the shared appreciation agreement marketplace. And we've learned a little bit more from Mayer and Brown, a law firm. This is some detailed reading. I appreciate the fact that they really go into the weeds here on this particular issue, but I'm going to summarize for you today just some of the proposals that are being made. So Illinois is not the only one that is creating regulations for the home equity investment or home equity sharing agreement companies. In fact, we had Maryland enact similar regulations back in November of 2024. Also, Connecticut rolled out their own requirements just this year, and with the aim of helping protect seniors. So let's talk about some of the regulations that are being proposed presently. One would be a required disclosure and financing agreement that would have to have a clear model disclosure within 3 business days after the individual applies for that particular home equity investment. And it would calculate annualized cost using standardized federal methods. And if terms do change, a binding commitment has to be issued at least 72 hours prior to closing. Part of that proposal would require the disclosure of alternatives to the home equity investment or equity sharing arrangement, and that would include traditional savings plans or refinancing with a traditional mortgage loan. Then there is the critical question of how the home's value is arrived at, the valuation process. And so these companies would be required to explain how that fair market value was determined and if they applied any discounts to it. Now, that seems to hint at a practice that we have seen in lending of having the lenders or the investors ask for slightly lower or more conservative appraised values, which would broaden their safety margin. And lastly, we have required counseling. Borrowers must get independent advice. It could be from an attorney, a HUD-approved counselor, or a tax advisor so they can better understand how this particular home equity arrangement differs from traditional or even reverse mortgage loans. As Mayor Brown observed in its final analysis of these proposals, these rules tend to mirror a growing national trend amongst regulators, and it's treating equity sharing products or arrangements as mortgage instruments, and therefore to be subject to stricter oversight. So for companies that are providing these equity sharing arrangements, Mayor Brown says the message is clear. You have to update your licensing. You have to adjust or improve your disclosures and build counseling programs to stay ahead of compliance. We'll see how this plays out, and we'll let you know in a future episode.